clauses legally could a lender invoke on their developer clients?
There are a litany of clauses. There's some of the obvious ones, and there's the not so obvious ones. So the mainstay of your loan agreement is split up to undertakings, representations, events of default. There are obvious ones like non-payment, insolvency, cessation of business, abandonment of site, etc. You've got the more tricky ones like MAE clauses. That's quite narrowly defined. I think it'd be quite troublesome for lenders to do that, but there's now recent academic argument that they could use that. But there are not so obvious ones, which are, so for example, you have to comply with all your insurance obligations, and you'll find your insurance contract. Have you kept the site adequately secured, inspected, regularly inspected, that sort of thing. So you could fall foul of some of the more less obvious things. The way that those agreements are written, they are robustly in favour of lenders, as you would expect. I think when we negotiate these documents, we get to a point where a lender says to a borrower, it's fine, we appreciate what it says in a black letter, but it's about relationships. And now you're going to find out how good those relationships are, and whether you picked a good lender or a different type of lender. And then it comes back to what Dan has said about professional, experienced, resilient lenders who know the market. And then I have to say, we've been seeing that if you've picked a good lender, that it's working well. It's working well for good developers and good lenders, and they are collaborating and working well together, as Ed has said.
Great. Ed, I think in a conference that we were in together last year, you actually said, probably not in the same words, but you said that when the going gets tough, you'll be looking at working more with principally funded lenders. So out of interest, certain funding models have been impacted harder than others in this environment. You will see a shift in how lenders are funded in the future, and how brokers are working with certain lenders depending on how they're funded.
Yeah, absolutely. So a lot of loan-on-loan lenders, including some of the most prominent, have pulled funding lines, and the impact, or the worst hit, are the lending platforms that don't have either multiple funding lines or committed funds, which actually, going back to the question that Dan answered earlier in regard to the Corona clause and the valuation, that's the kind of thing that we see making the big difference in this market. I think a lot of the platforms that have had funding lines pulled are always cautious to say they are not lending. And there will often be, obviously that immediately kills your pipeline, which takes a long time to build. So there are often reasons that come out, such as we can't lend with a Corona clause valuation, or might be an example of that. But how will that affect the market? I think, as I said before, in uncertain times, as a debt advisory business, we always look for principal lenders that can that have secure funding lines, and lenders that can make decisions like the decision Dan has made with regard to the valuation. It means he doesn't need to phone up the bank that he's borrowing from, or their bank to get their view and get their sign off. He can take the view as a principal. And that's what's really important for us at the moment as a debt advisory business, to ensure we're working with the right principal lenders that have got the capital and can make the decisions. I think this will be a very hard market for the lending platforms outside of that. I think as well, peer-to-peer, a market that already had lost quite a bit of confidence, is likely to suffer further. And yeah, we will be very focused on committed funding lines. I think we'll see more private capital re-enter the market, so more family offices, something that we'd see increase already. prior to this crisis. I think that will continue. I think there'll be more high net worth, lender clubs, investor clubs, if you like. And in some ways, we'll see a return to more traditional balance sheet and committed capital lending for the short to medium term, anyway.
Out of interest, how resilient is kind of overseas funding, securitizations as a source of funding, deposit funding, which is kind of the bridging market especially has become a lot more institutionalized in recent years. And also in the development space, but what are the most resilient funding lines, and what are the least resilient ones that you're seeing currently in the market?
I think in regards to securitization, we have seen a big upshift, especially in short-term lending, and we've seen both principal lenders lending into platform become principal lenders on their own, like Oaktree, for instance, because they can get the return they require on their own. I think we've also seen a lot more US lenders where they have a more mature securitization market looking to adopt the same approach as they've done for years in the US into the UK market. I mean, I think it's too early to see what the impact of this will be to that. But I do think we will see the shift to principal lenders, balance sheet lenders, and private capital. I think if you're in a position where you've now got committed funds, you stand to do well, or you'll be leading from the front, if you like, in a situation like this.
I think there is a concern that there are a number of short-term and development lenders who are funded by the same institutions, and if one of them are impacted, then they could all be, which means less.
Yeah, I think you're right, and all of the platform lenders have parameters that they need to stay within to satisfy their loan on loans. And the question will be is if there is a shift in values, for instance, and they breach those covenants, which means there's a cash call for them to satisfy, whether they'll be able to satisfy it, and if they can't, what the impact of that will be.
I think that is a concern, Ed, and I hear that from many where they've accessed liquidity lines, and I think the alternative lending market has become quite sophisticated in its approach. That they access repo lines, CMBS lines, private money, junior capital, and there are managers out there who are very sophisticated and pull together multiple sources into a structure to then on lend. And many of the borrowers of that money are completely unaware of the structure that sits behind them, and it only needs one of those threads to be pulled because the CMBS market is closed, and therefore they can't issue new paper, or they can't issue new paper at the correct price, so they can't put money in. That means there's a shortfall for funding. Next quarter's construction drawdown. You only need a thread to be pulled, and it can cause huge problems. And as Ed said, I am almost certain there will be lenders out there that will have cash calls because their underlying providers are struggling or looking at ways of recapitalising money, and are therefore putting pressure on the lenders. And the lenders will then need to find a way of meeting those cash calls. And as Ed said, that was some peer-to-peer lenders found that historically, where they would enter into obligations without necessarily having all the money in the bank to meet those obligations. There was a requirement for them to raise further money in future periods to meet their obligations, and in some cases they couldn't do that, and that is unfair on the borrower who has borrowed that money because they get caught short.
Do you think both the bridging and the development market will start looking like it did in terms of competition and products and the amount of lenders in the space? Do you think it will start looking like it did 10 years ago?
Ed and I had that conversation only yesterday. We were debating what the landscape might look like, and undoubtedly there will be, as always happens, there'll be people who have got problems in their book, so they'll be backward looking, they won't be able to do the business. There'll be providers of finance who are just not interested in the space anymore, and then there'll be people who see an opportunity to put money to work in order to get attractive yields off a recalibrated valuation basis. So plus change in some respects, because some players will disappear, new entrants will arrive, but I think you're right. I think there'll be definitely reduced liquidity in that market for a period of time. But it goes back to my earlier point that there is still a lot of money and equity in the world at the moment that needs to find a yield, because they need to meet pension liabilities, they need to meet insurance liabilities, they need to provide their investors with the returns. They're getting zero in the bank at the moment, so they will source out products and ways to get yield to meet their own requirements. So yeah, there'll be a short-term retrenching, and then the new lenders will emerge, and that won't be just for real estate. That will be, Niccolò's already made the point that he has been unable to acquire sites at a price he's happy with because he gets outbid. And we see that because there are a lot of people who will have a lower return requirement or a higher risk appetite. But that money will come along. This should hopefully give very highly experienced developers like Niccolò the ability to buy those sites, deliver those sites, and deliver the returns that he requires, because a lot of the people who may be less experienced have been taken out of the market.
And just a final question for everyone. With the lending currently more conservative or even temporarily halted in some instances, is now a good time for lenders to take stock of their current loan books, we briefly mentioned it earlier, and plan sustainably for the future?
I think first of all we need to ask the question: has lending stopped? And I think we've found that out with Dan's insight earlier, that it hasn't actually stopped. If we review the market, mortgages paused, took a step back on the LTVs. Now they're returning to 85-90% based on automated valuations and so on. They've expressed loan to value control from a lending perspective. That's how you push back on your applications that you don't want coming through the door. Automated valuations are becoming more the norm on the mortgage side. So the residential sector, for example, is still going. The wheels are still turning. We're hearing of completions every day in our office from our regulated team. But then you break it down to asset classes and commercial finance. Supermarkets are booming at the moment. Industrial warehouses are pretty strong. And then you've got the flip side, the hospitality sector, leisure, retail, hotels. There's a huge question mark above those, and how will they return? They will return, we all know that, but what does a new norm look like for them? So rather than talking about how lenders can take stock of their loan books, I think it's more of reviewing what their appetite looks like going forward, what the realistic funding arrangements can be made for some of the hospitality sectors that are struggling at the moment. Retail, does it resurface? Does it resurface the way it was before, where it's compartmentalized into sole trading businesses and small outlets, or is there a few big fish owning quite a lot of the sector on the high street? So I think lenders are going to review how they lend. I think they'll look at what they want to lend going forward, who they want to support, and what loan to values that they'll be comfortable at, and how they value things. There's been talk of commercial valuation. So traditionally you've got your VP, you've got your 180-day, your 90-day, and your full investment value. Is there something in between? Because at the moment, if you had an investment value commercial term facility agreed, arguably that's nowhere to be seen at the moment at the levels that you probably lent the money. So is there a weighted average investment value that's going to be introduced to the market that lenders will feel comfortable lending at? We don't know, but it'll be interesting to hear from Dan and the other guys of how this will return, because what does the new norm look like from our perspective? We don't know, and we're curious to find out, I guess.
Does anyone else have anything to add to follow on from what Matt said about? Yeah,
I'll just go very quickly. I think that to answer your question directly, I think all experienced long-term lenders who are here historically, currently, and in the future will absolutely have taken stock of their loan book. And I think that is just a natural thing for the lending community to have done. They will have have gone through loan by loan. They'll have bucketed them into risks. They'll have done scenario stress testing, and they'll have done a lot of analysis to understand their loan books. Some will have done it quickly, some will have taken a long time, and will still be doing it from the sheer number of loans. But they will be doing that, and there will as a result of that, some will say, right, well, we're going to suspend lending. I suspect many will just focus on what they consider to be core, experienced, high-value clients. That's typically what happens. There's a flight back to the proven, high-quality borrowers that they have worked with in the past. But undoubtedly, as the market opens up a bit more, more opportunities will be presented, and people will sort of return. I suspect what will happen, and typically happens in these situations, is, as we've alluded to, is an entry level leverage is reduced. And there'll probably be some upward pressure on pricing, which will put a greater requirement on the equity to kickstart projects. But I think there'll be a period of taking stock, sorting out the problems, dealing with the problems, working with borrowers, and then looking forward to the future. And again, because it comes back to the point, how does a lender make money? A lender makes money by lending it. If a lender doesn't earn money, then there's no margin coming in, and that quickly ends up in costs exceeding revenue, and that lender goes out of business. So they need to lend money, and they will do.
Great, thank you. Does anyone else have anything else to add, just to follow on those points, or anything which we haven't discussed already?
I think I'd just say that I think it comes down to quality lenders, quality borrowers, etc. And the proof is in the pudding. I think we're seeing more borrowers being on the front foot, talking to the lender straight away, agreeing waivers, seeing things coming down the road. There are lots of time-bound conditions that they have to meet that clearly are being pushed out, and that's key. And again, we're seeing those two, lender and borrowers, working together. I personally think there's been a correction has been expected in the bridge market for a while. It's yet to happen. This is not what I was expecting it to be. But again, I think maybe it's a bit of a revolving door, as Dan had said, where you'll get those going out, but others coming back in. I think there was always, in recent years, a race to the bottom in pricing, and that might come back to bite certain people that they've gone for that sort of a lender who hasn't got experience or the skills to stay with them and take them out of this situation.
I agree. I think it'll be an interesting and potentially a positive recalibration of the market, and also kind of who has the power, because I think based on broker and lender I guess the power balance there, I think that potentially will change from what it has been historically. Michael, did you have something? Carry on.
I think from the valuation perspective, I agree that the funding market isn't dead at the moment. We're still getting quite a high volume of new instructions coming through. I think going forward, dialogue is probably the most important thing between the lender and the valuer, and it's often a case of what is the question being asked. I think currently, just sort of saying, well, what is that worth, is not necessarily enough for a lender to understand and work out the risk. And I go back to this point that you need a line in the sand, and by having a valuation sort of almost pre-COVID gives you that starting point, and then sensitivities can be done, and market sentiment can be reflected, so that the lender is then fully aware of all the valuation risks in order that they can make their lending decision.
Matthew, sorry, I cut you off as well, or Ed.
Go on, Ed.
Yeah, I think just really to add to the comments so far, I think there will be a short to mid-term liquidity squeeze. And I mean, this comes from a highly liquid market for a long, long time. So it was expected. And I do think we're going to see some casualties. We spoke about the the lenders with limited funding lines or non-committed funds. I think we will see some casualties. I think as a debt advisory business, what's really important for us at the moment is that we provide our customers with the right advice, understand who the principal lenders are, what their likely parameters are going to be, and service that market the best we possibly can. I always think in uncertain times, there's a far greater need for good qualified advice.
Yeah, and that's where the lender and broker relationship is very important as well, because with experience you can provide that right advice, and if you've got a lender who, as Dan pointed out, can be pragmatic in the approach to a material uncertainty clause, which we would expect to stay with us for a while now, then a good experienced broker can then show the client what realistically the options are, and vice versa. We can give the lender an idea of what the sentiment is from a developer's perspective, and hopefully together they can come up with the correct solutions, and that's what it is. It's about providing the right solutions in the right market at the moment, because there'll be a lot of loose ends looking for good advice, and there might not be that much good advice out there at the moment because some people are panicking and some people are hiding in the corners of the room. So it's a case of making sure you're there, making sure you're having the conversations such as this and sharing advice and understanding what people are thinking, understanding what Niccolò's thinking on his side of the business, what the lawyers are thinking, what the lenders are thinking, and collaborating that together, and being able to translate that to both the clients and the lenders, in order for there to be some kind of equilibrium in terms of advice and borrowing and lending. So I think communication is very important in this sort of market and going forward.